bring in Hans Albrecht, joining us from Capital Advisors. A guy definitely who has a lot of experience running funds and running options strategies as well, collecting income. Hans, we spoke back in the day on my show at your previous shop where you were, we talked funds. And, I think the combination now of what we're seeing in the options market and then a lot of the ETFs that are using options, it kind of feels like a lot of the worlds that you've been involved in are, coming together here. And I'm sure you see it similarly to how I have here from the floor.
Hey, Oliver, thanks for having me. Absolutely. I mean, look, from when I started doing this about 15 years ago, I started running those income funds. This market has absolutely exploded. And as we know, we have the single version of the covered call funds, and they've really sort of captured the attention of so many people with this idea that you can kind of generate income while you sleep on the weekends on your favorite stocks. And it's amazing. And the way that sort of worked its way into the volatility landscape has been very interesting because as we know, these funds, and I'm to blame for this too, when I ran these funds, you're compressing that vol. And so that upside tends to be compressed because it's very supply driven, right? The call side of the skew curve. And we know the downside is sort of demand driven. And so we've really kind of created these environments where that upside becomes very, very interesting. And so as we've watched this incredible rally, I've been screaming for a melt up for about 1,000 points now. We've seen that upside get remain very, very cheap until fairly recently. We're starting to see that upside really kick up. And that's very interesting.
That's price for calls. You're talking about the options premium you're paying for calls because generally they've been pretty cheap despite the steady grind, right? That's something Brent Kochuba and I have talked about as well. I think it's an important truth of this market to understand. But you're saying maybe it's starting to change a little?
100%. So it's been not just the overall level of implied volatility, which is what you're talking about, but also that upside call skew. So when I start to see that call skew, as we vol traders sort of look at all the tea leaves, and when you start to see the call skew start to pick up a little bit, that can be a sign of excitement. That can be positive. What you want to look for is a sign of exuberance, of kind of eventually exhaustion, really, which is when that upside call skew just gets sort of too FOMO-ish.
So we're not even close to that yet, right?
Yeah.
So we're not even close to that yet, is your point, where maybe it's starting to show a little bit of that energy, but still generally pretty calm, nothing that looks like it's exuberant or manic.
It's not too crazy. Now, it's hard to get super bullish. I mean, I'm massively bullish overall, but in the short term, I mean, it's as you talked about earlier, it's very difficult for the bears at this point. There's really nothing to hang your hat on. There's really nothing apart from technicals and just having gone too far.
Who cares?
Yeah.
It's part of our system at this point. So I hear a lot of people talk to like geopolitical risks or governmental risks. And I don't know, Hans, to me, that's just like the number one building block in the wall of worry generally.
Well, I mean, if you look at sentiment, we've never quite seen a market like this where you see a number of measures of sentiment that are actually very, very low. There's a certain segment of the population that is quite dejected and not very happy about things. But the market is telling you that something good is happening. And the fact is GDP is strong, retail sales are good. There are a lot of very, very positive things. All this worry of recession and stagflation, it's just not happening. And there's very, very little evidence to show that that's happening. Now, if you back out AI from the economy, now you start to see where some of that worry comes from. But we are having a bifurcation of market and Main Street that we've perhaps never seen before.
Hans, how important is it that a key part of the strength of this economy has been household ownership of equities, which is at an all-time high, individual investors who have been successful in their portfolios? I mean, this is what we're talking about with Robinhood at all-time highs, options-driven strategies. I know people who literally have quit their job. Earlier this week, I had a call with somebody who runs a $60 million portfolio, and he just learned options in the past decade from watching Tom Sosnoff on Tasty Trade. I mean, how important is the fact that people can invest in these tech companies, that we can basically live off capital markets, even if these AI are displacing some jobs? Is there a connection there that we should be making?
I think there is, and I have been talking about this a little bit, how you're probably going to see, as we start to see the job picture unfold, you may get people more interested. Now, I covered this way back, Oliver. We've known each other for a while. I covered this way back, the whole industry 4.0 and all that. And I remember even years ago saying, listen, if you can't beat them, join them. That means just if these things are coming for our livelihoods. I don't want to be negative here, but there's quite a bit of
Yeah, no,
disruption
I don't
out
think
there
it
in the
is.
job
Yeah.
market. I mean, you
If you
might as
can't
well
beat them,
invest
join
in
them
them. You might as
or
well
invest
in
in them, right? If you can't beat them, invest in them.
Yeah. I mean, look, you almost have no choice. It's your hedge, right? In a sense, you're hedging out this eventuality that is unfortunately coming. I think it's a little bit more collaborative. I think AI is a little bit more collaborative. But if you look, there was a chart I saw the other day showing productivity really starting to take off with jobs just being as we know, there's no hiring. So this is very real, and it's actually early innings. And this inference stage of how this starts to play out throughout economies, extremely early. We are not first inning. We are on our way to the ball game. And so we're going to start to see some big things to potentially worry about over time. But in the meantime, I think the market's going to love it. And I'm actually quite positive overall because it's about profit margins. You talked about like if you look at who are the spenders, it's the retirees, the people with assets. You talked about home ownership. If we start to see rates come down a little bit, you start to unlock some of that equity. So without question, this has not been a fair environment for this certain segment of the population that has suffered from inflation, that does not own a home, that does not own many stocks. This has been an asset holder's dream, and they are the ones driving the bus right now.
You reward the ones who are, invested into it. So there's kind of a, look, that's how capital markets are. They can be brutal.
Exactly.
They will leave people behind. They're designed to. Hans, so speaking of which, maybe a good time to bring up AI, as it is collaborative indeed, helps me without a co-host. I asked the AI that we've been using if there's something near term that's a threat to the U.S. stock market or a potential source of volatility. It says everyone points to jobs reports or CPI, but those have already been heavily hedged and priced in. The real blind spot is the gap between calm equities and stressed credit and treasury markets. Bond volatility is high, credit liquidity is thin, but equity options are still cheap. So if hedging flows are forced or a credit hiccup happens, then the S&P could gap violently. I like its point about the big data releases not really being a big factor for volatility necessarily, but I'm not sure about the credit situation. It doesn't seem like there's too much volatility there. I mean, bonds continue to kind of firm up. What do you think?
Yeah, and that's where you have to dig a little deeper for those signs of stress. Now, the good news from an equity standpoint is that equities are a little bit slow. They're a little bit like, what's going on? So we start to see some of those warning signs early in other asset classes and other areas. So we definitely want to watch for those. In the equity world, what I look at some simple things like, where's realized volatility? Okay, it's down in the sevens, it's in the sixes, sevens.
Right.
When you see
that part,
gap,
the AI gets right. The volatility price for equities is definitely low. I think the AI got that part right.
And that's where you start to worry. When I start to see a gap between the VIX and actual short-term actual volatility, it's the market telling you that something is a little bit out of balance there. And so from a short-term perspective, I'm a little bit worried at this point. We could be not far, as bullish as I am, we could be not far from 30% sell-offs in some of these AI names that have really had a wonderful time.
Hey, well, Nvidia just broke out. Hans, okay, so then you got any specific trade for me? You got something that's on right now we can keep track of, we can watch?
Well, I've moved into a little bit more value. So out of things like AVGO that are trading well above their 10-year averages in terms of valuations, and into things like Micron, which is more U.S. focused, more memory focused, which I think people are underestimating. You look at things like—
Nice rip in Micron today. Huge.
Beautiful. A beautiful move today. And even some of the I think Mag 7, well, guess what's doing well? Suddenly Tesla's doing well. I think they are one of the great moonshot stocks out there. It's for a specific part of your portfolio. You do not want to get crazy on something like this, but think about— no one even talks about their power generation. It's robotics, it's cars, who cares? It is about power generation. These guys are sitting there. They've got scale. It is a one-man show, so there's always the risk that you've got one man running it. But I think that's a very interesting.
It can also be the one man you want to run it. People love Elon.
It is.
Here's the chart for Tesla at 460 right now. I mean, it's a pretty nice looking move. Pulling up Micron also, that rip there to 180. That's a pretty darn good looking chart. And you don't think this is a one-off move here?
I don't think so. I think option pricing is actually a little bit interesting there, compelling there. Whereas in some other names, I'm seeing a little bit of exuberance, a little bit of excitement. In Micron, I think this is a name that could get up into the 220, 230s rather easily, because they're in an area, that memory area, which people have been underestimating. Look at those Western digitals. Look at those Seagates. This is an area where it's like a backpack you got to put on your GPU. There are no GPUs working properly without memory. So I like it very much.
Okay, nice. Love it. Micron, watch. Tesla chart 2 picking up. NVIDIA ripping as well. So,
Google
yeah,
cheap.
I mean,
Yep.
you don't want to really get in front of that freight train.
I don't
I don't
think
know
so.
what
You
the
mentioned
bearish take
NVIDIA.
is when these stocks are breaking out.
No, I don't think you want to get in the way. I don't think you want to be bearish. I think that's how this market's going to go. And I actually think that there's going to be a bit of broadening happening, because if you look at profit margins, they're starting to curl up a little bit in the small and mid area. And think of what the internet is going to do. What did it do in the 90s? It set us up for decades of the internet. What the big cap hyperscalers have done is they've set the foundation for an inference move into the broader economy. So I'm actually getting quite constructive on other parts of the economy that can now benefit from all the fun that these guys have had.
Yeah, love that. Nice, good value take. Appreciate it. Hans, good to catch up. Good to have you on the show.
Thanks, Oliver.